All right, we are ready to go. We are live. I just want to say hi to everybody out there. And I've got a presentation to go through to talk about the all-weather strategy, talk about strategy in general, and take any of your questions related to investing globally in Thailand, anything like that. So I just want to say thanks to having me on. And I'm gonna go through my presentation and share some of my views about what's going on and the positioning of the all-weather strategy. So my name's Andrew Stotz, and I just want to say thank you for having me, and please bring your questions on. So shall we get started? Let's go into my presentation and see if we can get that rolling. There we are. So what I'm going to be presenting to you today is what I call riding the stimulus-led recovery. And in this presentation, I'm going to be talking about a few things. But before I do, just for those people that don't know me, I've been studying, teaching, working in finance, as well as investing for 30 years. Also, some of you listen to my podcast. I've done more than 400 episodes about investment mistakes called My Worst Investment Ever. And this gives me some unique perspective on risk management, a main thing that I focus on for the all-weather strategy. Because ultimately, the all-weather strategy is about trying to capture most of the upside that we can, but also protecting the downside. And also, I live with my mother in Bangkok, and there's mom and me at a festive party. So so what we're going to talk about in this riding the stimulus-led recovery is a few things. The first thing is that I'm going to walk you through the methodology and the objective. Now, some of you may already know about the all-weather strategy and how it works. But if you don't, I'm going to explain as simply as I can through this section. And then I'm going to start to go in and talk to you about this stimulus-led recovery. And then I'm going to talk about inflation. I've got a lot of charts and graphs in here. I've tried to keep them as simple as possible, but I'm going to show you how inflation extends the 12-year U.S. market rally. And then I'll talk about weighting and where I'm at. But particularly, I'm going to talk about why I'm favoring commodities right now and Western equity. And then I'll take any questions in Q&A. So what I wanted to just mention is ask your questions now. Last time I was on, I had so many questions. I tried to answer them all. I love your questions, and I keep track of them. So please ask those questions now, and I will do my best to try to answer them. And so let's get into the first part of this presentation, the strategy, methodology, and objective. If you're new to this strategy, I want to introduce you to the FVMR methodology that I use. And let's talk about that. Now, here is how I look at my stock selection and market selection. At the top of this diagram, you're going to see earnings. At the bottom of this diagram, you're going to see price. And who's responsible for earnings? Management. Who's responsible for price? Well, that's us, the investor. So the FVMR format first focuses on fundamentals. Of course, we want to buy companies or markets that have strong profitability and they're managed well. Of course, we'd prefer high or rising profitability. You can't always get that. But the second element is valuation. Now, you'll notice that valuation is the bottom of this diagram, because valuation is really related to price. It shows how the market perceives the stock. We, of course, prefer a company with good fundamentals at low prices. And, we have to consider a balance. You can never get everything your way. The next thing is momentum. And you'll notice that I have the word momentum in the upper portion of this diagram and in the bottom portion, meaning momentum is related to both earnings momentum and price momentum. You'll see a lot of times that on phenomena, they talk a lot about earnings revisions and earnings momentum. That is a key element. Now, you'll notice at the left, I say that I want to avoid value traps by looking for positive price and earnings momentum. Also, at times, low momentum signals an out of favor opportunity. Yeah, I'll tell you a story. When I was a young guy and I was an analyst, I saw the value of a particular shipping stock in Thailand. Some of you guys may know it, Precious Shipping. And I thought, this stock is so cheap on a valuation basis. But I got trapped in it. And it was a value trap because it was so cheap that I thought, this is great. But the reality is, 3 years later, it started to rise. I waited 3 years in that story. And instead, I probably should have just looked for positive price momentum. And so now I always look at momentum. And finally, there's risk. of course, we prefer a business that has low business and price risk. And of course, the other thing is a lot of people think that, you got to pick every stock that's going to fly, but it's not the case. Sometimes you need stable, strong stocks that may not go up by 10 times or 20 times. And that's part of reducing risk. So for everyone out there, this is the FVMR strategy that I use for picking stocks, as well as allocating money in portfolios like the all-weather strategy. So let's talk about the objectives of the all-weather strategy. There's really two objectives. The first is to capture the most of the global equity market's long-term growth. People make money in the stock market. We're not going to make money by betting on gold or betting on commodities or betting on bonds. Stocks are the proven winner over decades. And then we're going to blend in some other asset classes to protect against most of the equity downside. And actually, this is a great lesson that I've learned over the years, and I want to share with you. And that is that I never think of other asset classes like commodity and gold as my primary asset class. The equity is always primary. And I really challenge you to think about it that way. And then you see the function of these other asset classes like gold, like commodities. Yeah, sometimes we're going to win on them. Sometimes we're going to lose on them, but they can protect the downside. All right, let's talk about the investor goal for you as an investor in this strategy that I provide to Phenomena in the Guru Reports. Our goal is to provide investors a strategy that reduces the time they need to spend on managing their money. For a lot of people out there, they're very happy to pick stocks and spend all day looking at charts and graphs. And I know how that feels. I've built my whole life around that. But the fact is that there are many people out there who really don't have the time. They're working in their jobs and they're trying to make money and make ends meet. And they don't want to think about it. That's part of what this strategy does. Now, there's three drivers of the strategy. The first, I'll call it GLD. The first is global. This is a global strategy. It's not a Thai strategy. The second is it's long-term. This is not about catching a little uptick and uptick and get out when the market goes down. This is about building a long-term, stable investment strategy. It could underperform for a period of time, but I'm going to stick with it and try to grow the money over time. And finally, diversified. I'm trying to diversify it as much as I can. Now, I know that diversification will take away some of the return, but it's going to reduce some of that risk. So let's talk about global. What do I mean? This strategy invests globally, not only in Thailand. Let's talk about long-term. Well, gains from long-term equity return while trying to reduce a portion of the losses during an equity market downturn. That's what we're shooting for. And next, diversified. What does that mean? Diversified globally across 4 asset classes. Now, I know some people have said, hey, can you mix in cryptocurrency as a 5th asset class? Well, that's something that I'd like to talk more about at another time. I think there's opportunities to do that. But for right now, we're going to focus on the 4 asset classes. Now, let me ask you, do you know who these people are? Do you know who the first person is? Well, everybody knows the first guy on the left. That's Warren Buffett. And do you know who the guy in the middle is? Type it into the comments if you know who is the guy in the middle. You know who that guy is? Let's see. Hopefully you got it. Well, for those of you out there, that is Charlie Munger. But my question is, who is the guy on the right? Does anybody know who this guy is? The guy on the right is Peter Lynch, and I got some books of his up behind me. Yeah, Charlie Munger, right? Okay, Payon, that's right. Kankavi, Somchai, yep. Mina, Peter Lynch, well done. Yeah, well done. You guys got it. Peter Lynch is awesome, and when I was starting in the stock market, I started in 1993 in Thailand. There was no books, there was no online courses, there was none of that. I just had to try to learn whatever I could. So I got books, particularly from Peter Lynch. Peter Lynch was great, but all of these guys are amazing. So if you know someone who wants to become an expert in valuation, just going to mention, I have the Valuation Masterclass Bootcamp coming up. It starts on July 26th. These are some of my most recent students, but now we've moved it online. And if you're interested, it's the only program that trains you exactly how to value actual companies like a pro and get a dream job in finance. And this is what my connection at a big US bank said about one of my boot camp students. And I'm looking for more students. So if you know a young person that wants to learn valuation from me, let them come. This is one of my students. His name's Baum. And he says, the guy that I introduced him said, he's got all the tools to be really successful in valuation. I'm floating his resume internally to my entire network. So part of what I'm trying to do is connect young people to professionals around. So I have a special offer for you that are watching this now. There's a QR code you can take a snapshot of right there. And that gives an early bird discount for Phenomena viewers. So if you're interested in that, it's a special offer. Just make sure that you use the code Phenomena. Don't forget it. Remember that as you go to the website that takes you to. All right. So let's talk about riding the stimulus-led recovery. Welcome to the inflation upcycle. What do I mean by that? There's unintended consequences of the global economic shutdown. Now you may say, Andrew, this is a COVID shutdown. No, it's not. To me, it's a global economic shutdown. Countries did not have to shut down the economies in order to deal with COVID, but they decided to do that for different reasons, right? And the end result of that is we have unintended consequences like supply chain disruption. We also have losers have been pushed out of business. A lot of companies have been crushed, and that's causing a contraction in supply. And when we have a contraction in supply, that means there's less products being sold in the market. What happens when less products are being sold? Prices go up, and that's why I see continuing inflation. Meanwhile, demand is starting to rebound. So take a look at America. A lot of people are being paid to stay home, but they're not producing any new products to bring into the economy, but they're demanding products. And the result of that is demand is outstripping supply, and we've got a problem. We've got inflation. Surviving companies, of course, have access to cash. I know some of you guys have been faced with this challenge in your jobs, in your companies, in the companies that you own. I've had to face it in my companies, and let's see how we can get through it. Now, the last time I was on Phenomena, I presented this chart. This chart, the red line is inflation over more than 100 years. And basically what I said is that now we have been in an inflation down cycle for 40 years, and it's over. Inflation down cycle was driven by a falling oil price and falling wages from China, workers in China at low cost entering the workforce. Those are the two drivers of deflation, but that's gone. And I think we're moving into a period of inflation. Now, also, last time I talked, I said that I expect rising inflation. That would be the green line in this chart, that we'll see inflation spike. In fact, I've shown that every single peak in inflation is war, and war is a defining element of inflation. And I also think that the likelihood of the US starting a war now that Biden is in charge is higher than it was under Trump. Also, the US-China conflict remains. Tariff increases are pushing up the consumer price index and costs, and less inflation. Imported goods means deflation. So we want to have a stimulus to spur inflation at some point. And the end result is that I'm expecting inflation to rise. Just want to make sure that's clear. Now, the 40-year fall in inflation has reversed. And if we now put the U.S. long-term government bond yield, the blue line here, what you're going to see is that the yield has now gone below the inflation rate just recently. And then if we look at that, we can calculate a real risk-free rate, which is simply the government bond rate minus the inflation rate. And that real risk-free rate has gone negative. Generally, that's positive for gold, but that's also tends to be negative for the economy. Now, we can also see this chart. I looked at inflation across the whole world, Thailand, US, China, and I took the GDP of each country and I weighted their inflation number with their GDP relative to the total. And what you can see is that inflation rate is running at about 3.8% right now. It is a world of inflation right now. So what is inflation after all? For those of you who have known me for a long time, I've been teaching in Thailand for 30 years. So I love to teach a little bit. So let's have a little lesson. Inflation is a general rise in prices in an economy. It's caused by money supply growing faster than the rate of economic growth. And as a result, each unit of currency, whether that's baht or dollars, buys fewer goods and services. It reduces the purchasing power of each unit of money. Now, another way of thinking about inflation, I want to challenge you to think about inflation as a fall. It's a little bit weird to think about inflation as a fall because normally we think of inflation as a rise. But inflation is a fall in the value of money. And that means everything else gets expensive. So what inflation is not, according to monetary inflation theory, inflation is not rise in specific goods or services or rise in prices in a specific industry. If you told me oil is rising, just because oil is rising doesn't mean we have inflation. Inflation, according to the monetary theory, is really just when all prices rise because actually what's happening is the value of the currency is falling. So that's the concept from a monetary perspective. Now, there's more to it. Keynesian economics says that changes in the money supply do not directly affect prices in the short run, and inflation is not only about monetary policy or the price of money. Inflation is also the result of demand pressures in the economy expressing themselves in prices. And if we think about that, then we can say that it could be that the value of the currency is falling. That means all prices are rising. But the second thing that this could mean is that it could mean that when there's a lot of new demand for products and services and there's not supply catching up, we can see prices rise in economies. So it's more than just a monetary phenomenon. Now, let's just look at two types of inflation for a moment, demand pull inflation, and also we're going to have cost push. But demand pull inflation is an increase in aggregate, meaning total demand from increased private and government spending. When everybody's spending, demand is rising. It stimulates investment and economic expansion. Imagine if everybody was spending in the economy, we would be in a situation where companies would want to invest more to capture that spending. So it stimulates that type of investment. Now let's look at a cost push inflation or supply shock inflation. It's a drop in aggregate supply caused by natural disaster or increased prices of inputs. Just think about supply of many products has been reduced because of the global economic shutdown. Rising oil prices get pushed through to retail prices, and employees demand wage increases to match these consumer price rises, and that further pushes up inflation. So let's look at an example of cost push inflation. Supply chain disruption and destruction causing commodity prices to rise. It's happening right now. Commodity prices have been rising, and I believe that we'll still see commodity prices rise from here. Now, this is an interesting chart. What I did in this chart is I looked at actually one of my team, who was also a valuation masterclass student, Chris, who works with me. He did this chart and we went over it. And basically what you can see is that the red bar is China. And we're looking at cement as an example. China consumes 55% of the global supply of cement. In other words, their consumption is massive. The same for nickel, the same for steel. It's high. Copper, wheat, oil, all of these things are very high. Now we know that China also depends on coal, so there's less oil, but still there's a lot of consumption. What does this chart tell us? This chart tells us that if China is strong, commodity prices should rise. If the economy of China is weak, commodity prices should fall because demand from China will fall. Now, we see that China's economy is pretty strong, and that is putting upward pressure on commodities. And it's part of the reason why I'm overweight commodities in the portfolio. In fact, I created this index where I started commodities. I rebased at 2011 at 100. They fell a lot, but now we're seeing that commodities are rising. And let's look at an example of demand pull inflation. What does that mean? Well, the US government dropped lending standards and lowered home mortgage rates prior to 2008 crisis. I have a book up on my shelf that explains the 2008 crisis, the global financial crisis, and explains something really important behind the scene. The US government and politicians were telling the banks and telling Fannie Mae and Freddie Mac that was buying these mortgages that were being lent. They're telling them, lend to people that cannot pay back. And they forced them to do that. That pushing and dropping of lending standards caused a huge volume of new people to come into the market and start buying houses. This brought many of them in, and it drove up demand, and it caused real estate prices to skyrocket. Yes, you heard me right. The cause of the global financial crisis in 2008 was not greedy bankers. It was the US government that caused it. And I can prove that, but that's for another time. It was, now greedy bankers are always around, and so we can blame them a little bit, but it's amazing when you start to see what the US government did to cause the crisis. So here is a chart where I look at the consumer price index, which is the blue line, and it steadily rises. And I look at the producer price index, which rises a bit more. But the most important thing is the green line. That is the housing price index. And you can see to the left, you can see an arrow that I put up there. That arrow is basically showing the boom in housing prices that happened in the 2008 global financial crisis, what caused it. But look at that chart today. The inflation of housing prices is massive. The US in particular is heading for another housing crisis that could be even worse than the one they experienced in 2008. Now, it may be fueled with low interest rates and more people buying. It could go on for another 6 months, 12 months, 24 months, but I believe that it is going to become the next major crisis. All right. So as a teacher, I'd like to end up with what are the key points of what I'm trying to share with you. First, US inflation upcycle has started. Real US government bond rates have gone negative. Cost push inflation is happening with commodity and shipping prices, demand pull with housing prices. And it's starting to feed through into retail prices. What's the bottom line? It's the end of a 40-year inflation down cycle. If you have any questions on this section, put them in now. I'm going to continue on, but I will get to your questions at the end. Let's move on to talk about how inflation is extending the 12-year US market rally. For those people who follow the AWS portfolio and strategy, you may have wondered, why are you moving money from Asia over to the US? Isn't the US an expensive market? Well, I'm going to talk about that. This is a table, and I believe that we can provide this presentation to you in the comments. We'll put a link in there so you can download it. But here's where I look at CPI, Consumer Price Index, over, if I go back and look at it, let's just look at the US at the top. So the US, basically, I looked back and I said, if consumer prices, meaning inflation, was rising in the past 3 months at any time, what was the probability of a positive forward return in the US market, in this case, in the next 12 months? And it was 78%. And from this, I can see that rising inflation pushes up the US stock market. And that's part of the reason why I decided to switch back to the US. Now, I may not be in there long. I may switch it from there, but that's one piece of evidence. Now, let's talk about the US stocks and how they're nearing a peak. The past decade has seen moderate real book value growth, but massive multiple re-rating, meaning the PE has gone up massively. Recent inflation surge could be a shorter term driver for the market. Now, this chart is a fun one. What I did is I went back to the major market falls in the US since 1900. The first fall, which I've labeled number 1, lasted 5 years from 1917 to 1922. The next fall, number 2, lasted 4 years. The next one, number 3, which was this was basically the dot-com bust, lasted for 2 years. The 2008 financial crisis lasted for 4 years and was pretty massive, down 79%. That's the EPS, or earnings per share, of the companies. But what's interesting is that the 2019 to 2020, we basically saw EPS collapse by only 20%. And it's now back rising again. That's amazing. To think that we've had a global economic shutdown and yet EPS did not collapse as much as it did in the global financial crisis. Now let's look at that in chart form. Remember these 5 points that we looked at. Now I've just put them in a chart form, and the vertical lines show the number of years that the EPS fell. But the key thing that you can see is that the EPS falls have been less and less in the most recent time. Why is that? Did you ever meet somebody who couldn't see their child suffer? If their child cried at all, they immediately brought them candy and gave them a hug. Have you ever seen anybody like that? That is like the Federal Reserve these days. The Federal Reserve just can't let anybody suffer. So they will pump in money, even if it means destroying the economy, to prevent the EPS from collapsing and the market to collapse. Now, the other thing that made this crisis different was that a lot of companies got wiped out. So the existing companies actually had less competition. So they had pricing power. Now, recently I was on Twitter and on my LinkedIn, and I put out the question, what US S&P average annual return do you expect over the next 10 years? 18% of people said greater than 10%. 51% said 5 to 10%. So the majority of people are thinking pretty positively. Now I'm going to look at that in a little bit more detail. What return do you expect from the US over the next, let's say, 5 years? Can you put that in the comments? I would like to see what return you think the US will give over the next 5 years. What return do you think the US will give over the next 5 years? Just type it into the comments and let me just get your ideas. The US stock market return over the next 5 years. What's the average annual return? I'm looking for your number. Anybody got one? All right, let's see. Niti, do you have one? Okay, Pickled Pepper says 5 to 6%. Okay, let's see. Tanat says 15. Roy says 4. All right, yep, there we go. Roy says 4. Let's continue. Okay. Narit says 8%. T says 10. Okay. About 10%. Waraporn. Okay. 8%. And then B, that's my favorite. Nit noi ja. Okay. We got 10%. All right. So those are your numbers. There's 20. Baum says 25. Mina says 20. Mime says 20. Wow. You guys are pretty optimistic, I would say. I'm going to try to answer this question. Chanya, one of my favorite students, says US would give return about 4%. Okay, let's now go in and try to answer this question. And I'm going to teach you about something that I created to help me to understand the market. So let's look at this for a moment, and I'm going to go through this slide. The first thing is there's 5 things that affect stock market return. Number 1 is inflation. Number 2 is the dividend that you get. Number 3 is the real book value growth. Number 4 is share dilution, which share dilution is captured in the real book value. If a company issues a lot of shares, the book value growth will generally slow. And finally, there's the dream factor. The dream factor is the thing where people think about the future. So this is what I'd call it. So let's look at these 5 components of stock market return. Number 1, inflation. It's a rise in prices, and you need to be compensated for a rise in prices. Whether you're putting your money at the bank, in a bond, or in the stock market, every single interest rate in the world has inflation built into it. So that is one component that you're going to earn when you're in the stock market. Number 2, you're going to get a dividend yield. That's cash paid from profits divided by the share price. Number 3, you're going to get real book value growth, meaning the growth in the equity from retained earnings. Number 4, you're going to get share dilution or accretion, right? When shares are issued and the company doesn't make a lot of money from that issue, then it's dilutive. And finally, dreams. So let's look at this in more detail. The first 4 components, that's inflation, dividend yield, real book value growth, and share dilution, can be easily calculated. Let's look at the dream factor, though. It can't be explained by the prior factors. It comes from when investors' expectations are either dreams when their future expectations are of massive profits. Think about the value of Facebook. Think about the value of Apple. These are trillion-dollar companies now, or close to it. People's expectation of the future is massive, right? And then there's nightmares. For those of you that have lived through market downturns, you can find the nightmare scenario when future expectations are of collapsing profits and tough times. So let's talk about the dream factor a little bit more. It's based upon what investors are willing to pay. When dreams are big, investors are willing to pay a high price for the same amount of earnings. But when there's nightmares and you read the newspaper and everything's crashed, investors slash the price they're willing to pay for the same amount of earnings or book value. In other words, when a PE or price to book multiple is re-rated, meaning it increases, or when it's derating. This is dreams and nightmares. So I've created this chart of the US stock market going back to 1991. And what you can see here is a couple of things. The first one is the brown bar is inflation. It's almost always positive. Inflation is something that we're compensated for, and it's always there. Number two is the real book value growth. That's the blue bar. And generally, it's positive. In 1999, it did go negative. In 2008, it did go negative. And in 2020, the book values of companies shrank. Now, the third one is dividend yield, and that's the green bar. And you can see green bar is steady, very steady. And then finally, that red bar is the up and down of the market. And that up and down is the dream factor, which is the multiple re-rating. In fact, 9 of the past 12 years saw a multiple re-rating. And all that you got to do is look at this, and I'm going to just go and see if I can do this. I'm just going to get my pen here, and I'm going to say, look, when the red bar is very high, it's usually followed by the red bar being very low, meaning re-rating of the multiple and then a de-rating of the multiple. So where is the red bar here? Well, we've been high most of these years, and that's part of the reason why I'm expecting that we're going to see some de-rating in the US market. Now, let's continue on. Again, this presentation is in the chat notes. So if you want it, just click on that and you can get it. But I just want to look at this from another way. Let's imagine that you put $100 in the US market back in 1991, in 1990, and basically you let it grow. It would grow to become $1,785 by 2020. Well, everybody knows that. But the question is, where did that growth come from? And that's where this whole dream factor analysis comes from. And here we have it. You can see at the bottom of the 1785, 299 came in from inflation, 478 came from real book value growth, 292 came from the dividend that you earn, and 619 came from the dream factor or the re-rating of the price to book in this case. So you can see a very high re-rating driving the market up to 1785. Now, the next thing I did is I asked the question, I did some academic style research where I asked the question, when the dream factor is high, what happens to future capital gain? And you can see in this chart that almost every year capital gain is lost. It's a negative. So when you buy high dream factor, meaning the PE or the price to book value has been re-rated to a higher and higher level, when you do that, the chances of you having a long-term return that's positive is low. Well, if I put all this together and I just look at 5-year periods, what we can see is that the period from 2016 to 2020 in the US, we had a return of 15.8. The period before that, it was 12.7. But you can see those green, although the red bars here show that there was a big re-rating. We can see the big re-rating here, and then a fall and a de-rating here. And we already started to see that de-rating. And this is part of what I'm expecting the de-rating to look like in the next 5 years. In the next 5 years, I expect the US stock market to return about 3% average annual return. Now, you may say, Andrew, that's crazy. Nobody's going to invest in the U.S. market if it's earning a 3% return. But remember, there was a time where the U.S. did earn a 3.3% return. Now, I hope that I'm wrong and the U.S. market returns higher than that. But my expectation for the next 5 years for the U.S. market is pretty low. So, would you guys like to see Thailand? I did this analysis on Thailand. Would you like to know, is future return going to be high or low? Is the dream factor going to be high or low? Now, I am going to take a question here. Boom Manchali says, how do you estimate the dream factor? Well, first of all, if we look in the past, it's just the re-rating of price to book or PE. But you're asking me how I estimated, and I have to admit, I guessed. Basically, like any analyst, we guess. We take information that we see, and then we try to make our best conclusion from it. And that's how I came up with it. So that gives you a little bit of an answer. So let's look at Thailand. Here you can see the dream factor doesn't even appear in the last 3 years. No dream factor. Yes, and best SLZ, you are right. The dream factor in Thailand is not really high at all. We just haven't had that much re-rating. Remember, if we go back and we look at the US for a moment, how much money did you end up with if you put money in 1990? You ended up with 1785. So how much did you end up with in Thailand? 862. Much lower than 1785. And where did it come from? This is an interesting chart. You can see that 280 of that 862 total return came from inflation. 674 came from real book value growth. Well, that's good. That's a good number. And that's what we should see in a developing market, that, they're growing book value. We did get 443 from dividend, but that dream factor was a negative drag. So for best SLZ, you are right. The dream factor is low. So if I look forward and I see when dream factor was high in Thailand, we would see that generally it meant low returns in the future. But here you can see that dream factor, as we just saw, the red bar is low in Thailand. So to estimate Thailand's returns, I go back and look over time and try to make my best guess on this. And I would say we probably are going to have average annual returns in Thailand of maybe 11% over the next 5 years. Now, that doesn't mean that the next 5 months or 5 weeks is going to be great. But I would say that Thailand is due for a re-rating, right? So now we can see some of that applied. Let's review what you have learned. The key points: EPS and margin down cycle in the global economic shutdown has been fast, but now is on an upswing. Remember, it was only 1 year it was down. Also, expect long-term 5-year average annual U.S. equity return below 5% and Thailand above 10%. Bottom line, well, the high dream factor makes long-term U.S. equity returns low, but it's likely to rise because we've seen in the short term, we're getting an inflation push. And that's the reason why long-term, I'm more bearish on the U.S. market, but short-term right now, I'm more bullish. And that tries to explain to you why in the all-weather strategy, I started to overweight the U.S. Now, that could change at any time, but that's where we're at. Let's go through and look at some weights, reviews, and outlook. And then I'm going to move into your Q&A. Well, I want to review the 4 asset classes. Remember, I've told you that the number 1 asset class to focus on is equity. Think about this. I have a company in Thailand called Coffee Works. My best friend runs that company. We co-own that company. And there's a fantastic management team in place and a lot of great employees. And they're working their butts off to try to survive in this climate right now, in this very difficult time. The point is, as an outside shareholder, I'm not doing that work. I'm doing work in my own business. The point is that if you invest in all companies in the world, like world stocks, you have the management teams of almost 10,000 companies, 10,000 CEOs, 10,000 management teams working for you to overcome the impact of inflation and all kinds of things. And that's why we see that over the long term, stocks around the world do the best. Now, I'm going to go into the next thing, which is bonds. And you can see that we have had a bond market rally, but you can see that it's not that much of a rally. When bonds rally, they don't move that much. This line of the bonds, the blue line, it's a great way of understanding why I said at the beginning of this presentation. Remember, at the beginning of this presentation, I said, I don't invest in bonds or gold or commodities to make money there. I invest there to protect the downside in the equity. Because if you could properly predict when equity is going to fall, you switch that money into bonds, you would be sitting on that blue line. It wouldn't go anywhere, but you wouldn't lose that much. Pickled Pepper says, perhaps the dream factor in Thailand, let's just see, I'm going to put this one up. Perhaps the dream factor in Thailand would come back high again under the new government administration. When is the new government administration? That's my question for you, Pickled Pepper. So, but I think that that's true. As a new administration eventually comes in, maybe they'll drive the market. Okay, let's now look at the next asset class. This one is gold. Now, gold has been a terrible performer over many years. You can see it. If you put your money in gold and you thought you were safe, no, you missed a huge opportunity in stocks. This is a reason why you should never have the majority of your portfolio in gold, because it just never goes up. And in fact, it can go up at times. We did have a rally in gold, which you can see right here. But then that rally started to slow down. And here we can see that slow down. And right now we're just sitting in gold, doing its job, which is to protect wealth. We have about 5% of the portfolio in gold. Finally, commodities. Wow, look at that. When stocks were rising, commodities were falling. Now, we have played commodities recently because I think we have a lot of pressure there, but that also can mean that the stock market could come down a bit. We'll see how that goes. Those are the 4 asset classes that I use in the all-weather strategy, so you can get to know. Now, I'm going to try to answer a couple questions as we go along. I see another question here. Let's see. Mei Yi says, do you think nowadays inflation can make the global economic shutdown? And what's the number? It's not hurt the economy. Basically, I would say that we probably could have 3-4% inflation without doing too much damage as things get back to normal. But if it goes much above that, I think things are going to be dangerous. Remember, ask your questions that you have, and I'll do my best to try to get to them as I continue through the presentation. We're almost done. I'm going to walk through some performance numbers. Now, since inception, since we started the all-weather strategy, the per annum or annual return has been about 9.7 for this strategy. For the 10 months of 2019, it was about 10.8. That was our best time. In 2020, it was down. It was up by 3.4, but we didn't catch a lot of that U.S. market recovery because we were protecting the downside. And then in this year, we're up year to date about 8.7. Now, remember, you may say, well, Andrew, the stock market could be up 20%. Why are you only up 8.7? Because I'm not trying to capture all of the stock market return. I'm just trying to capture a bit of it and protect the downside. Now, I will take another question I see coming in from Khan Kawi. Says, will you switch commodities to equity? If you listen to the way I talk, Khan Kawi, I would say, if you listen to the way I talk about commodities, about gold, and about bonds, you can basically see that, yeah, in reality, I'll switch out of that commodities at some point. Will it be in a month? Will it be in 3 or 4 months? That really depends on what's happening with inflation. I'm happy to ride that commodities just a little bit. Now, another question came in from Roy. Man, I know your thoughts. Just released US CPI at 5.4 year on year, higher than the previous 5, higher than consensus. Yeah, this is why I'm overweight commodities, because I think the US is going to see rising prices. I mean, just look at the price of shipping. Price of shipping is massive. All right, let's go. We got another question here before we continue. Not says, how's Thailand going to has higher market return than U.S. in the next 5 years when you consider these facts? We are an old economy, no technology, aging society, political instability, and look at the net foreign funds. They're selling out. Well, not. You just made a great case for Thailand. Everything is negative. And when everything is negative, everything that you said are things that the market knows. And that's part of the reason why the market came down. And I would argue that that's part of the potential for the market going forward. So there's more questions to that and answers to that, but that's my first answer. Now, there's another good question here from Kunatip. Says, why don't you have REITs? Generally, what I've found is that REITs don't perform much different than equity. Remember, the property sector in the stock market has REITs in it. So if you buy REITs, you're also doubling up on your REITs exposure. So generally what I would say, for me, I've tested the ability of REITs to improve the performance or reduce the risk, and I haven't found that it adds value. So I keep it simple. I don't have REITs. Another question of what do you think about ARK for long-term investment? I don't know much about that, so I'll have to leave that one for you to do some work on. All right, let's continue on. We're going to go back to the presentation, and I'm going to go through the numbers. In the past 1 month, the AWS underperformed a traditional 60-40 portfolio by about 1.4%. Hey, you can't get it right every single time. And the fact is also I'm comparing to a 60-40 portfolio because it's better than comparing to, let's say, just pure equity. I'm never going to own pure equity. And what we can see is the US was the best performing asset. That's where we went overweight. The second best was within equity, and it was almost flat, though. That was Europe. And the fourth worst performer was commodities. So we got hurt on that commodity trade. Now let's look at it over 3 months. What we can see is that AWS outperformed by about 2.6, driven by commodities, which has been very strong over time, right? And I'm going to stop there and just pull up a comment from Nop, which says AWS seems to be protective rather than aggressive. Yes, that's correct. I'm aggressive in that I'm going to own equity all the time, but I'm always going to have the other asset classes to try to protect the downfall or when equity falls. Yes, you're correct, Nope. Next one comes from Mime Malady. Q2 10-year yields fell and started Q3 already falling while the market fears of inflation. Why is this happening? Yeah, that's a great question. I love that question. Wait a minute, Andrew, if you think there's going to be inflation, the US Treasury bond should be rising. Investors should be pushing up the yield of US Treasuries. That means US Treasury bond prices would be falling and the yields would be rising. Maybe we should have, instead of having a yield of 1.3 or something, we should have a yield of 2 or 3% to compensate for long-term inflation. Well, there's two things to think about here, Mime. First of all, is that remember, the bond prices are pricing in long-term inflation. So I'm looking usually at a 10-year bond. So you're thinking about the average inflation over 10 years. So even if inflation was 4% this year, 5%, it doesn't mean that the bond, the 10-year bond, is going to have 5% inflation premium built into it. It still may only have 2% or so if people think that inflation will eventually come down. That's the first thing that you want to think about in the case of inflation in the US. The second thing is that the US bond market is no longer a real market. We know that nobody's buying US Treasuries. The Japanese government's not, the Chinese government doesn't want to, European governments don't want to, and individual investors don't want to buy the US government bonds. And as a result of that, there's no demand for them. Now, normally when there's no demand, what would have to happen is that yields would have to rise to get people enticed to buy more of the US government bonds, because after all, the US government has to issue more bonds because they need the money. They're in way over their head. But we know that the Fed is buying every single US government bond that somebody else doesn't buy. And that will keep the yield on US government bonds low. And that's the reason why I don't count the US Treasury bond as a very reliable price mechanism anymore. I do want to answer this one. So Chachada Sing Cho Wong says, How do you think of the buy and hold strategy on equity? Can we buy at some points and simply hold in the long term without adjusting the port? Yeah, there's two things I would say to that. The first thing is that if you just buy a broadly based, now, if you just buy Thai equity, if the Thai equity market does terrible for the next 10 years, well, you're going to do terrible. So you could say, well, maybe the solution to that is I got to buy individual stocks that I like, but people don't have time. I don't know about you, Chachada, but I know that many people say, I don't have time to pick stocks. So your other option is to buy every stock in the world through different ETFs and different funds that are available now. And then you just hold that and invest in that over many, many years. If you did that kind of strategy, you would do pretty well. And the AWS strategy, I'm trying to do something similar to that. All right, let's continue on. I'm going to go back to the presentation. And here we can see the 1 year performance. AWS was at 0.1 above the 60-40 portfolio. So it hasn't been a great year for us, but it hasn't been terrible. Here we can see we're basically tracking a little bit below right now the 60-40 portfolio. Now, here's where it gets different though. AWS's volatility is lower than 60-40 because we're blending in the gold and we're blending in the commodities. In addition, what I'll also show you is that let's look at all the way to the left on this chart, you're going to see the blue bar that it says down 5.6%. That's the 60-40 portfolio was down 5.6% on the 12th of March in 2020. But the AWS portfolio was down less. And in the 16th of March, it was down less. In almost every single down cycle, the AWS portfolio is down less. So I'm trying to protect the downside. And that means sometimes I miss some of the upside. So let's go through the weights. The last change that I made was I kept the 65 weighting in equity. My maximum weighting is going to be about 85. I kept 65. And here's what I did. I switched the money from emerging markets in Asia Pacific into US and developed markets. So AWS does have somewhat of a, I wouldn't say aggressive, but I'm willing to trade the market. And that was my trade. And basically, it was the right call because U.S. markets done well. Western markets are where recovery is happening the most, right? U.S. is up about 2.5% since that change, and it's benefited us. Now, also, Europe has faster vaccine rollouts. We're seeing some of that in the equity markets, and basically, equities are down 0.2, right? So now let's look at the outlook. We've got an outlook, of course, in Europe that is vaccine rollouts, not so bad. The Fed and ECB are open to overshoot their inflation targets, so let their economies go. And then this could drive inflation expectations further. And rising inflation and positive sentiment could drive the US and developed Europe market. Now, I want to warn you at this point, be careful about following what I do by just following this presentation, because I can change this strategy at any time, and I may. So just follow the strategy as best that you can through phenomena, because otherwise you may see that you're making changes that I may not make. Now I see an interesting name. There's Dr. Narate Surasit. And he says, according to your idea, what assets will be worth investing after COVID-19 under control and why? You know, for me, the simplest answer to that is own equity. Own equity. Now, you can say, doctor, that you could own land, because if inflation rises, land tends to rise and the value of currencies tend to fall. So I would say that land and that type of thing could be something that you could consider owning, right? Next one is from Tian Boon. Says, should we buy US S&P 500 at this level? It could crash at any time, right? That's what I'm saying. Be careful about following what I'm saying today, because I'm talking about how I've been positioning the portfolio, but I could change that at any time. So take into consideration that I'm riding the US up, riding the inflation wave, but knowing that at some point the US is going to come down. All right, let's continue. I'm going to go back to the presentation here. And for bonds, we have a target allocation of 5% as they appear less attractive relative to equity. We hold Thai government bonds rather than a mix of global and government and corporate bonds. So we consider equity and commodities to be more attractive. Hence, we're keeping that bonds at the minimum target allocation. And here you can see the commodity allocation has been 25%. We've stayed with that. Basically, the only change that we made this time was a change within the equity, shifting into the US a bit. Here are the 5 types of commodities: energy, industrial metals, livestock, agriculture, and precious metals. All of them have been up since we switched into the commodities. And I think that we still have a ways to go for commodities. UAE and Saudi Arabia are unable to agree on production plans for August in OPEC plus meeting, and it could lead to higher oil prices. US, EU, and China's economic recovery should spur inflation expectations and put more demand on commodities. You know, I had a group of students that were talking to me recently, and they were talking to me about ESG and about oil price. You know, we shouldn't be consuming oil anymore and all that. And I asked them, how many of you drove to work today? And all of them raised their hand. This is a problem that we have. Everybody wants less pollution from oil, and they're saying to the oil companies, stop drilling for oil, but nobody stopped driving their car. And the result of that is I think you're going to see oil prices continuing to rise. All right, we do have another question here from Chanya, my student. She says, at Phenomena Slide, hi, Mike, ha. All right, yes, we actually, if you look up in the comments, you're going to be able to see you're going to be able to see the slides. I think Alex has put a link in there for you. Okay, next question comes from Boonman Chali. Okay, should it be the right time to buy AWS now, or is it too high price now as the move to US at all-time high during this time? Well, remember, I reconsider and rebalance AWS every 3 months. So it could be 1 or 2 months that I switch it around and I may get out of the US and move into something else. I'm trying to do the timing of the asset allocation so that you don't have to. So when people ask me about timing for putting money into AWS, I would say I wouldn't think about it too much. I'm trying to do the timing myself. Next question came from EE. Bitcoin versus gold, which is the best hedge against inflation? Well, I would say gold is going to be probably a better hedge against inflation. You know, when you think of the word hedge, we don't think of speculation. We think of kind of protecting. But the fact is that Bitcoin and all kinds of cryptocurrencies are very, very volatile. So just as much as they could go up, nothing wrong with having 1 or 2% of your portfolio or 3% of your portfolio, let's say, in cryptocurrencies, but just know that they can also come down massively. Of course, gold can come down also, but I would say gold has a longer reputation as being a hedge. All right. Inflation is up, land and real estate up. Some REIT categories would go down. Leasehold would be up. Am I right? Generally, I would say yes. Generally, I would say yes. All right. Alex has included the link to the presentation, so you can go to that. Next question. What from Not again would that be the bad news for growth stocks in the long term because their capital costs would increase from inflation? Yeah, there's definitely going to be some cost increase, but I would say I wouldn't think that that's a disaster for value stocks or for growth stocks in general. I think cost of capital are exceptionally low. What's going to happen is prices are probably going to fall when cost of capital starts to go up. And when price starts to fall, it will compensate for that higher. So that's part of the reason why I think the U.S. in particular is heading for a potential fall. It could be 3 months. It could be 6 months. It could be 12 months. Okay, finally, let me wrap up. You guys have a lot of great questions, so I'm going to try to get to them. Let's just look at gold right now. Gold, I'm at 5%. I'm going to skip through that part because I think you get the point. Let's get to the key points and the bottom line. In the past 3 and 12 months, AWS has beaten a traditional 60-40 portfolio, meaning 60% equity, 40% bonds, while slightly underperforming it since inception. AWS has experienced less volatility and lower drawdowns compared to that 60-40. And right now, since March, AWS has targeted 65% equity, bonds 5, gold 5, commodities 25. And we're currently favoring commodities and Western developed markets. So now we move into Q&A. And before we go in, I just remind you, if you know anybody that wants to learn valuation, I mean deeply, to become an expert, tell them about the boot camp. It's an online boot camp for 6 weeks. They'll basically get real life experience writing research. They'll learn from me exactly what I learned, and they'll get closer to getting the interview that they want to get their dream job. Remember, just scan that. And this is until July 16th, so you've got to act now. It's a special offer for Phenomena, so you've got to use the Phenomena code, Phenomena. And I think Alex may put a link into the chat there. All right, let's go to Q&A. Let's go to Q&A. I think I'm going to just start to go up the Q&A here a little bit, and I'll start putting us up. So the first one, how long shipping cost rise will end? Yeah, it's all-time high. It's not actually an all-time high because we've gone back and had shipping costs massive. But yes, it's a recent high. And I would say that there's no end in sight to the trouble with containers. I know in America, they're having trouble getting these containers. And basically, I would say shipping rates could stay high for a while. And that feeds into everything. Okay, tape. Putipon. All right. What do you think about China market now, given China government aggressively put the control over big tech companies? Well, China, I would say that to me, I'm not too worried about China. And I think that the Chinese government, when they saw the tech companies getting more power than the government, basically the government smacked them. Now, that's what my opinion of what they did. And they said, you're not going to get bigger than the power of the political parties. So tape, I would say that the message has been sent from the political parties. Now tape, compare that to Facebook and Google and Microsoft and these different companies. The US government, the Congress, the House of Representatives, the people are represented by these House of Representative members. They call the tech giants, the leaders of the tech giants like Mark Zuckerberg and Jack Dorsey from Twitter. And you know what? Those guys basically said F you to the congressman. In fact, they deplatformed the president of the United States. So I would argue that part of what's happening with tech in China is the leader of China is saying, you're not going to do to me what they did to Donald Trump when they deplatformed him. So I would say it's just a bit of a power struggle. All right. Some other question. Roger, how do you expect the dream factor in Thailand in the next 5 years? Will it keep low or will it be higher as the US? I expect, Roger, that the dream factor will start to rise. When everybody's depressed and they think Thailand's never going to be able to go up again and all the demographics are against it, that's the time that a market starts to rise. So generally, I'm positive on Thailand. Let's look another one. Booms for gun. All right. What is the current situation between US and China? Will it affect the market long term? I think that things have calmed down now. And I just expect that we're just going to see less engagement between China and the US at this point. Now, it is possible that China and US escalate the South China Sea. I just read a good book about that. And basically, it's very possible that that happens. I suspect that it will probably happen over Taiwan. And we could see some really, really difficult times from that. But I suspect that we won't see a war coming out of that. All right. Next one, Daisy Fern. As your views, if I would like to invest about tech stock fund and have term to invest about 1 year, is it the right time? Or if I expect return of about 10%? I would say that it's a little bit dangerous to invest in tech stocks right now. Their profit margins are so high and their multiples are so high that it's hard to see that they could go up that much more. So I would just say, be careful. Now, that probably means that you could put a little bit of weighting in tech stocks, but I wouldn't be overweighting or massively overweighting. Mei Yi says, what do you think about equity market with QE tapering and what is going to happen? Well, QE tapering basically is saying that the Fed doesn't have to do anything more. And basically, what you're going to see from the QE tapering is that they won't be allowed to taper. They won't be allowed to taper. Why? Because if they're tapering, they're basically going to let interest rates start to rise again, and they can't do that. Oh my God. I just want to say, I just noticed there's 775 people on this. We've got 97 clicks of a like, a love, a shock, or a smile. I want to thank you all for being on this. And we've got so many great questions, but I appreciate to you guys and to Phenomena for having me on here to talk about it. And I've still got more that I can answer. So I'm going to go back to some of the questions. I'm going to go all the way up to the top because some people in the beginning asked some questions and I don't want them to feel like they've been missed. Okay. So Santi says, what's your view on NASDAQ all-time high right now? Again, NASDAQ, I would be careful. Like tech stocks, I think there is some risk. All right. Okay. Maybe I'm not going to be able to read that one. All right. What is your view about China? I think I've expressed that one. Jib. Tanit, what is your definition of defensive stock? You do consider U.S. tech stocks like Apple defensive stocks? Can expensive stocks like utilities be considered defensive stocks? Okay. I just looked at utilities, and what I found when I looked at utilities is that they haven't behaved that defensively. So if you want to think about defensive, I would highly recommend that you think about healthcare and consumer staples. That's it. Focus on those. Those to me are defensive. All right, let's continue. Just say hi. All right. Yeah. Teparit, nice to see you. Yes, I think I see you on my Facebook sometime. It's very nice to have you in my fan club. Gal says, you got this. Love it. And Sorowit says, is the rising inflation expected to be transitory or permanent? I think that the rising inflation is going to be high for the next, let's say, 6 to 12 months. That's going to be a real impact on the market and the economy. So whether you call that transient, transitory or permanent, I wouldn't know. But I would say that it is going to be impactful, right? It is going to be impactful. Well, Supercorn says, what's your view on Asia and India? I think generally Asia is good. And in fact, once the U.S. does start to come down, which I believe that it will, I think that Asia will fall also. But what will happen is that I think we'll see money get allocated more to Asia. And that's where I think relatively positive. India, India is an interesting market because India has a very small number of investable companies. So it tends to be pushed up pretty aggressively. But I'd say the longer term for India is pretty strong. If the AWS would not be about all weather, if the strategy would focus only on good weather, how would the strategy look like right now? So if all I said is I wanted to ride the good weather time, I would be more weighted in US equity. I would be more weighted in equity. I would be riding it up. But I've lived through enough crashes in my life to know that you have to protect for the downside. All right. NSSV says, can you explain about inflation and relating to chip price situation right now? I think that the inflation, remember that inflation is a fall in the value of a currency. That means everything goes up. But the chip situation is just a shortage in chips. And that shortage is causing some price increase. All right. Supergorn says, how do you view U.S. market? Debt levels up caused by U.S. dollar less value. I think eventually the U.S. dollar is going to come down. I think the U.S. dollar is going to come down. Okay, MK, most developed countries are seeing aging populations, hence reducing demand. Shouldn't this factor drive lower inflation? Yeah, I agree that there's an argument. In fact, I'm going to start working on doing some videos about inflation versus deflation. But I would say that the inflationary impacts of the global economic shutdown are pretty significant. All right, I'm going to head back to the bottom to go to anyone's. And Tirapat says, I love this live. I love that you love that. And I love the questions. All right. Korakot says, what do you think about investing in CLMV indices? Is it still laggard compared with EU, US, China? What do you think? This is an interesting one because CLMV indices have a low correlation to the US stock market, just like ASEAN has a low correlation to the US stock market. That means if you are on this call and you're telling me, Andrew, you're nuts, the US stock market is going to crash anytime, then ASEAN and CLMV indices would be stock markets that you could own that have less relationship to the to the US market. Yeah, what about ARK? How the inflation impacts ARK? I know that Jessica and Jet and Bank talk a lot about ARK and the other people on the team, but truthfully, I don't know much about ARK, so I'm not going to say anything about it there. All right, Wisan, how is your opinion on Taiwan stock market? For me, Taiwan is kind of, the last time I was there, you just realize, like, in some ways it's a country just waiting for China to take over. It's just a little bit scary when I go there. So from a longer term perspective, I'm not that much of a buyer of it, but I don't have a great opinion on it at this point. Dr. Narrate says, the first time to join your program, thank you for good information, ideas about investment. Please share your ideas and pros and cons of EV cars. Is it worth investing? I would say from a long-term perspective, EV is interesting, but just remember that, it takes a long time for some of these things to be adapted. Tiwa Porn says, love watching you. I appreciate that. I appreciate that. And, okay. Art Tosan says, will AWS focus on specific countries, for example, India or Vietnam? Good question. No, I have been talking with Phenomena about launching another strategy, which I would let's call it AWS Plus, AWS New Gen, where I will consider tilting it more aggressively towards countries like India and Vietnam, but not for right now. All right. Petri says, why will gold price not repeat the 2012 pattern? Concerned over QE. Yeah, I guess right now what people are saying is they're not that worried about inflation. But I would suspect that what we're going to see is that when people start to get really scared about inflation, gold will start rising again. And I'm just not moving into that until I see that positive momentum in gold. What do you think about investing in Tesla? Tesla is kind of crazy. In the valuation masterclass, I have some of my students value Tesla, and it's very hard to come up with a really good value for it. So it's a little bit of a dream there. But I would say for a small amount of money, I would consider putting in it. But it is a very expensive stock. Okay. Tuktik says, 5% of K Japan in AWS. Do you have any view on the Japanese market? Right now in the Japanese market, I'm kind of neutral. I don't have a strong stance. I hope it comes back. Personally, from an investor perspective, I like the Japanese market because there's a large number of stocks in that market that you can invest in. And I like it from a stock picking basis. Ben says, hi, what percentage do you think the existing Chinese stock listed in the U.S. market will be delisted? I would say 20, 30%. Because the politics against the U.S. are against China in the U.S. are very, very strong. Now, Roy did ask for my thoughts on Vietnam, and I would say generally I'm positive on Vietnam. Vietnam has become more liquid. I think it is an interesting one. And so, yeah, very, very interesting. Now, I did get a message from Phenomena folks that we're going to end this in a few minutes. And I'm just losing my voice a little bit. So I'll take your final questions, bring in any final questions that you have. And if I see any more, I'll let you know. Any more questions, bring them in. And then I think we're running out of questions. My goodness, there's been so many questions. I appreciate all the questions. If you have any more, bring it in. Otherwise, let's see. All right. Aza says, when the US dollars depreciate, will fund flows go too? So yes, I think it's very possible when the US dollar starts to depreciate. Basically, I think that there's a lot of people that aren't buying US treasuries as an example because they fear the US dollar is going to start to fall. And so the result of that is that I'm just really cautious about the US dollar right now. Roy says, thank you. I appreciate it, Roy. And Boom Sagan says, you're awesome. Thank you. Boss says, what do you think about SCB, comp, and inflation? Thank you. Actually, I don't have a strong opinion on that, but I do think inflation is a risk, and I'm playing it through commodities right now. What are the key factors that foreign investors consider important for investing in Thailand? Well, I think, what they're looking for, no matter what people say, all they're looking for is a improving earnings growth situation and not too expensive. Thailand's not an expensive market. If the government or if the companies can produce positive earnings growth, then just if they can do that, then Thailand should fly. Okay, Anna says, if I want to invest in the port, should I invest in all funds at once or should I wait each fund? I would say do them all at once because that's the way I think about them. I wouldn't do them one by one. If you want to do it one by one, just do it outside of AWS and do your own selection. All right. AJ says, thank you so much for your energy. Yeah, I'm bringing a lot of energy. Like some of you, I wake up really early. This morning, I was up at 3:30 in the morning. Papa Win says, thank you so much for your presentation. Much appreciated. And here, Phenomena says, whoa, you can subscribe. And if you got any more questions, we got some more here. When is the next time you'll be back live again? That's a good question. We'll ask the folks at Phenomena. I'm happy to come on live on a regular basis. I enjoy it. There's a lot of topics. I think one of the most interesting topics is inflation. I just want to do one show talking all about inflation. I find that fascinating. Kankawi says commodities such as metal was controlled by government, so the price will drop. Do you think it's still an uptrend? Yeah, remember that commodities is not all steel and metal. Commodity is oil. Commodity is agriculture like corn. Commodity is precious metals. Commodity is industrial metals. So yes, it could be that we see some tightening for steel, but I would say it's not enough to reverse it. Awesome as always. Thank you. Thank you very much. Take care, Teparit. Good to see you. All right. Good to see you guys. I appreciate Mei Yi. Thank you. Nitya, you are very welcome. Saran, thank you very much. I'm in AWS. I'm going to try my best to take care of you as best that I can. Nope. Thank you for a great session. I appreciate it. Brilliant and very informative. Thanks, Not. And can't wait for the next live. Appreciate it. Don Rutai. All right. I think we are going to call it at that point. I appreciate everybody on. There's 753 people on. I appreciate every single one of you. If you've got any questions, feel free to ask me. You can always reach out to me. I'm easy to get in touch with. And so there you go. Have a great day. Thank you, everybody, for having me on the show. And thank you again to Phenomena for having me on. I appreciate it very much. And Anne says, I invested in AWS for my 7-year-old daughter. And it's my goal to protect it and grow it and have her have a very great future. Thank you.
ก่อนอื่นเลยค่ะอย่าลืมกด follow กด subscribe กดไลค์กดแชร์เป็นกำลังใจให้กับ Phenomena ด้วยนะคะ